Welcome back to Getting Your Shit Together. I'm Neil, and as always, I've got my co-host Jerome with me. Jerome and I are going to go over some of the mortgage terms that anybody going through this process, whether you are purchasing a home, refinancing an existing mortgage, looking at a renewal. These are terms that you probably would want to know and be aware of the implications of these. So let's get started. Jerome, the first thing is mortgage. How is it different from a loan?
What's a mortgage? That's, do you remember those days when you were in school and they used to say, start your answer with the question?
Mm-hmm.
What's a mortgage? A mortgage is, there's a long history towards what the word actually means. It actually means dead deed. But it's a phrase used to describe a longer secured loan.
Mm-hmm.
A normal secured loan could be anywhere from 1 to 5, 6 years. These days, secured vehicle loans can go up as high as 8, 9, 10 years. But with mortgages, it's a lot longer. And the history basically is that when you got a mortgage, it was until the mortgage was paid off. And it was around the time when people died, I think.
Okay.
No, that's probably way wrong.
So essentially it is a loan, but a secured loan which is secured by the property on which the mortgage is advanced. And the lender has the right to take the property back in the case the mortgage is defaulted upon.
Yes.
Either the principal is not paid back or there are issues with the payment.
Yes. Yes. Okay. Why do I have to pay a principal?
Essentially, it is a risk mitigating process wherein as the obligation reduces, the risk to the lender reduces. Right. So that is where the need to sort of reduce the balance or the principal owing over a period of time comes in.
Yes.
So that is where lenders want in most scenarios, want a certain amount of the principal paid back each month or on a periodic basis.
Yeah. I was actually referring to the principal at my old school. Why do we need to pay him? Not that type of a principal.
Unfortunately not. He doesn't get paid, or she.
Yeah. Yeah. His pay was, I'm going to get
not
paid.
Anymore. Not
No,
anymore.
that's true. That's true. At least not in our country.
Yeah. Most places. No.
So principal.
So principal is the amount which was initially borrowed. So for example, let's say you're buying a property for $1 million. Your down payment was 20% of that, so $200,000. And you're looking for a mortgage of $800,000. So in this case, the $800,000 is the principal.
Okay. So yeah, the principal.
Okay. Now, what is the interest rate, and why do you need an interest rate?
Oh. This is probably the thing that I think confuses people the most, because I think they understand the gist of interest rate, which is the rate of interest which is being charged for you to borrow the funds.
Mm-hmm.
But one of the things that confuses a lot of people is the types of interest rate, and they keep hearing interest rates all over the place from different sources about different things. The interest rate that you pay on the mortgage is on the contract that you sign with your lender. And I'm going to use lender as opposed to bank because there are multiple ways to get a mortgage. Something that's really important to think about, Mr. and Mrs. Borrower out there, is to think about the compounding period on the interest rate that you're being charged, because it can make a huge difference on how quickly you pay that down versus how much interest you're actually paying.
Mm-hmm. So for example, let's say you got a quote which says 4.5% from two different lenders.
Yep.
One has a monthly compounding period, and the other has a semi-annual compounding period. So the question to viewers is it going to make a difference? And if so, which one would be lower, when it is compounded monthly or when it is compounded semi-annually?
That's a good question too.
Mhm. Okay, so let's move on to amortization.
Amortization period. So we talked at the very beginning about mortgage and that it's a long-term secured loan. So the amortization period is the length of that loan, the total time over which it takes to pay off your mortgage. An interesting fact on this is the longer amortization is, the lower your payment will typically be.
Mhm.
But it increases the overall amount of interest you pay on that mortgage. So something to take note for those guys thinking about 30, 35, and 40-year mortgages that are out there in various scenarios. You're going to pay a lot more interest on those versus a 20 or a 25-year mortgage.
So essentially, the payments are lower, but the proportion of the principal being repaid each month or with each payment is lower as well.
Yeah, exactly. So what's the term?
Okay, so term is, well, generally every mortgage has an amortization period. Now, the term is a specific contract or the period for which you are signed up with a lender. While the amortization period could be as long as, say, 30 years in many scenarios, the term or the contract period with any lender is shorter. So typically in Canada, we see 1 to 5 years or maybe in 10 years in some cases. So that's a term.
So what happens when their term is done?
Okay, so when at the end of the term, typically the obligation is that you repay the entire mortgage or the principal back. That's generally the expectation. But most scenarios, the lenders will offer you a renewal. If things have in good standing, then you get an automatic renewal, which you can at that point choose whether you want to change some of these parameters of the mortgage, be it the interest rate or the kind of interest rate or whatnot that you're choosing.
And can you switch lenders at the end of a term?
Oh yeah, for sure. Because your contract is done, so your obligation with that lender is done. As long as you're paying back the principal, you can move to another lender.
Nice. So my
Without
understanding,
the penalty.
right? My understanding, the difference between the way Canada does mortgages and the US does mortgages is, in the US, both the amortization and the term are effectively the same thing. So
For
you don't
residential
get,
mortgages, yes.
yeah, you don't get a 5-year term and a 20-year amortization in the States. It's,
Generally speaking, I think it's very, very rare that you would have anything like a term in the US for residential mortgages.
yeah. You get a 20, 25, and a 30-year term to pay off that mortgage. So
Yeah, but they do
whereas,
have some I think weird situations where maybe for the first few years it's a variable mortgage and whatnot, and those were the things which that 2009 scenario or fiasco.
some for sure. I think it was more, honestly, I think it was more underwriting related issues than it was anything else.
Mhm.
Watch The Big Short. That's a good movie that kind of really explains how it all happened.
Yep.
But I digress. Yeah, I see when you look at rates down in the States, they're basically 20, I think they're like 10, 15, 20, 25, 30-year rates. And that's what you're set up for. That's it. You're done, right? You're in a mortgage and that's that. Can you break it down there? I think you can. There are penalties. I don't think the penalties are the same exactly as the way they are here. But it's more important for me to share that that's one of the differences between the way the US does it and the way Canada does it. You can have a 30-year or even a 25-year long mortgage, but it's broken into smaller segments called terms that allow you to switch lenders, change the interest rates, change the interest rate type. So it gives you a little bit more flexibility, ultimately.
Yeah.
All right. So one of the rate types that you can get in those terms is called a fixed rate mortgage.
Yes.
And the proper definition is a mortgage where the interest rate remains constant throughout the term. So if you take a fixed interest rate of 4.2%, it's the same interest rate for however long that term is. So if you choose a 5-year term, it's the same rate throughout the entire term.
Yeah, and as a result of that, your payment also remains the same because your interest rate remains the same for the term.
Yes, yes. And it's a very steady graph showing the payment amount and the amount going to principal and the amount going to interest over time. You know, the amount going to interest is gradually less, but at a much steadier pace.
Yeah. It's like a staircase.
Pardon?
It's like a staircase.
Yes, very small stairs.
Baby steps.
Yes, exactly. So what's this other option that we have, a variable rate?
So there are two flavors of variable rate mortgages. Specifically speaking, one is called a variable rate mortgage, wherein even though the interest rate could change during the term based on the prime rate, the payments are fixed. So if the interest rate goes up, more of the contribution goes towards paying the interest cost and less towards principal, and vice versa.
Yes. Yeah.
The second flavor is called as the adjustable rate mortgage. Again, it is the interest cost will change depending on the prime rate again, but again, so will your payments. The difference between the two is the amortization period could change with a VRM or a variable rate mortgage.
Yeah.
But with the adjustable rate mortgage, your amortization remains on track. So if you signed up for a 30-year mortgage and you continue with that kind of arrangement, you'll get paid off in 30 years. With a variable rate mortgage, maybe not. It might stretch longer.
Yeah.
Or shorter.
Or shorter. That's right. It's like an accordion. One is the accordion moves out this way, and the other is the accordion moves out that way.
Yeah.
That's my technical way I explain to my clients, right? A variable rate is this way, and adjustable rate is this way. So
mine is the jargon, right?
Exactly. Mine is the jargon. That's right.
Okay.
So that's really interesting stuff, though. I mean, it's important, I think, when clients are making a decision about this type of a product, because everywhere today, people are like, should I take a variable? Should I take a fixed? Right? They're seeing the variable / adjustable rates coming down, or the Bank of Canada rates are coming down, and prime rate is changing. These are good questions to ask and to know, and somebody should be talking to you about these things when you decide which one you're going to take.
Yeah, so if you're hoping that your payments will go down in a decreasing rate environment and you take up a variable rate mortgage, no, you're not going to see that happen.
That's right. That's exactly right. Yeah, and if somebody hasn't talked to you about your type of payment in this adjustable variable scenario, I would say they have not done you a good service. My opinion. So
okay, let's move on to mortgage default insurance.
Yeah.
So when does it come into play?
If I default, I get paid the insurance premium for what I've been paying.
Good try.
No. So mortgage default insurance is actually It does benefit you, the borrower, to have this because it allows you to purchase a home with less than 20% down. Okay, that's the first thing that we need to say. The second thing falls very, very close behind that is the government has basically mandated that if you have less than 20% down, you must have this. And it's to protect the lender.
Yep.
So the lender gives you, let's talk about the scenario that you mentioned earlier, Neil. Somebody's buying a property for $1 million and they have, let's say they have $100,000 down, so 10%, and they need a mortgage of $900,000. Well, the default insurance is actually there to protect the lender in case you default on that $900,000. So there is a premium that, guess who pays for it? You, the borrower. If you default because of a job loss or injury or something like that, the lender can say, I'm not getting paid this $900,000 back from that client. I'm going to make the claim to the insurance company. The insurance company will give the money to the lender. The lender will sell the property or do whatever it is that they need to do. But then what happens? Does the insurance company do anything after that?
Oh, yeah, for sure. The insurance company can come after the borrower to get or to compensate for the loss that they probably incurred.
Exactly. Now, the loss isn't all the full 900,000 because the property is still going to be sold. The loss is the cost of selling the property and going through the foreclosure process and all of that stuff. So, but it could be quite significant.
Oh, yeah. Nothing comes cheap when lawyers get engaged.
No.
Another point to add is it can be a bit hefty. Like you're talking at least 2.8% of the mortgage amount. That's a minimum. And can go up to 4.5%, depending on the down payment and other scenarios.
Yeah. There is a program out there called Flex Down, and I don't know if we're going to talk about this. Do you have that in here or no?
No.
There is a program called the Flex Down, which allows borrowers to borrow a part of their down payment from like a credit card or a line of credit that they already have, but there is a repayment portion of it. The Flex Down comes with a premium or a surcharge on the normal default insurance, which could take you to 4.5% premium on a 5% down mortgage scenario.
And that could be increasing with our 30-year amortization rules.
Yes. They might not even allow the flex down on a 30-year amortization, right? Because then you're going to be at like 4.7% with a. So basically, you'd have less than 1/3% equity when you buy a home.
As good as another down payment.
Yeah, exactly. So it can be and is expensive in many cases, but something that's not well known is mortgage default insurance isn't an optional thing for borrowers when you have less than 20% down payment. It's a must. Okay.
Yep.
Simple as that. But if you have 20% down or more, the lender can decide if they want to get default insurance on your mortgage. So in those cases, the impact to you is typically nothing outward other than having to qualify using the default insurer's guidelines.
Plus a slightly higher interest rate.
In some cases, depending on that loan to value, yes. Because the lender is often going to pay the default insurance cost.
Yep.
So they're the ones paying the premium, and they like to pass that on to the borrower somehow.
Of course.
Yeah.
Okay.
Down payment.
Down payment? Yeah, down payment.
Yeah.
Okay, down payment is nothing but the equity that you bring into the purchase.
Yeah.
Again, talking about our earlier example, if you're buying $1 million property, you need a $800,000 mortgage, then your down payment requirement becomes $200,000. So that is what you go into the purchase with. That is a down payment.
So there is a minimum, and we talked about that. We've sort of touched on it already. The minimum is generally 5%. You can borrow a portion or even all of that 5% as long as the repayment is considered in the application and the ratios still work.
Or somebody could be getting a gift from their parents or close relatives.
Yes.
Yeah.
I would say, is there a maximum down payment that you can have? But I think the answer to that is generally no, because if you have
100%?
100% down payment, then you're effectively buying a house.
Yeah.
So I wish for everybody who's listening to the call today that at some point they have 100% down payment in all the properties that they're buying, just because I'm like that. It's not going to help my business very much, but I want everybody to have 100% down payment.
Well, for your primary residence, maybe, but still, I would not advise that.
Yeah. Call me. We'll put you in a HELOC.
Okay, so closely related to that is loan to value. What does that mean?
So the loan to value, the actual definition is the ratio of the loan amount to the overall value of the property. So, and then once you take the loan and then multiply it times the value of the property, that gives you a percentage of how much you owe. So loan to value is basically just that, how much you owe on the property, and then expressed as a percentage. Just helps lenders reframe things and categorize loans and stuff like that. And it's very commonly used in our industry for that purpose.
Yeah, it determines quite a few things when it comes to the mortgage and the pricing for that.
Yeah.
Now, value is a very tricky thing, right? Can you elaborate a bit more in terms of what value means?
Yeah, value. It's the bestest house in the world, and I wouldn't sell it for anything. It's priceless. Well, lenders don't necessarily feel the same. They want to put a sticker price on your home so they know what they can get for. And it's no different than, if you were to sell a car or if you buy and sell stocks. There are values for virtually everything.
Yep.
Lenders want to know at any given time, when you are going through the transaction, what is the value of the house at that time, right? Because you could buy a house today for that $1 million house, and then in a year, the market has changed and maybe it's only worth $950,000, just because there's less of a demand for it, et cetera, et cetera. The lender always wants to ensure that they are up to date on the value of that property.
And there's another scenario as well, right? So if somebody is purchasing a house, they may want to pay whatever they have to pay to get the house.
Yep.
Right. I can go out and buy a property and pay 1.5 million for it. But if the lender does an appraisal and figures that the property is worth only 1.4 million, then the value of the house is only 1.4 million for them, even if I chose to pay 100,000 more.
Yes.
So all the loan determinations are then based on 1.4 million rather than my figure of 1.5 million.
Yeah. I think there's, in my head, the way that I think about this is there are two ways to put a value on a house. There's one, what will the market support? And by market, I mean the general population. What would the general population say this house is worth? And then the second one is, what are you as a buyer willing to pay for that house? Because they're the only two numbers that really matter. The market value of the house is the same one that the lender is going to use, because they're thinking, if I need to sell, what is it worth?
Yeah.
Whereas you're thinking, I want that house. What am I willing to pay for it? So for you, a house is worth whatever you're willing to pay for it. But for a lender, it's worth only what the market can support.
Yeah.
So that brings us to the next one, equity.
Yes.
Equity. What does that mean? equity.
Again, it's a sort of a fluid thing. Equity at the time of purchase is close to what you bring to the table in terms of a down payment.
Yep.
If it is an existing property or something that you've held on for some time, then the equity could mean not just what you put in terms of down payment, plus any additional mortgage that you pay down in terms of principal repayments,
Mhm.
and also any adjustments that happen in the value of the home or the market value of the property since the time you purchase. So if the property value is increased, then that's to your benefit. If
Mhm.
it is decreased, then that's to the negative.
Generally speaking, when you buy a home, unlike a car, the home value starts to increase almost right away, right? Because every year over year, there is an increase in value of property. So your house value starts to slowly increase upwards. And what does your mortgage do? It starts to decrease as you make your payments. So the difference between the value, what the market can support, and what you owe
Mhm.
is oftentimes referred to as the equity.
Yeah.
That's I'm big into the hand signals, right? Like with the accordion and equity and, all this kind of stuff. I should talk to somebody with sign language to see if I'm close to how they would describe it.
Do you have an Apple Watch by any chance? Is it prompting you to be active?
No.
Okay.
I was, however, at a different Toastmasters meeting last night, and they were
Mhm.
talking about appropriate hand movements and stuff like that. So, anyway.
Cool.
Okay. So we've got a mortgage. We've used down payment. We talk about the value of the home. We talk about how much equity you have in there. What's left? What else do we got to talk about? We done?
Let's talk about prepayments.
Oh, repayments.
Both prepayment options as well as prepayment penalty. What is the difference?
Okay. Are you okay if I talk about the good part, the option, the prepayment
Sure.
options?
All right.
Okay. Prepayment options. They vary from lender to lender. They can be as low as 5% and as high as 25%.
Mhm.
When you have, in my experience, when you have a more restrictive, lower interest rate mortgage, they tend to want you to be able to pay off less because they want to make the money that they're guaranteed to make on the lower interest rate. When you have a regular featured mortgage, they'll allow for a higher prepayment. So, what do these prepayments mean? It basically means that you start with a mortgage. We'll talk about the $800,000 mortgage that Neil brought up earlier. You have your regular monthly payments, say they're $3,500, right? Whatever about the interest rate, but your regular payment needed is $3,500 every month. You can increase that payment by these percentages without any sort of penalty, without causing any, challenges or issues with the lender. So you can increase your payment, and you can also put a lump sum on the mortgage amount each year related to the second part. So a prepayment is when you prepay a portion of the mortgage. So you can basically pay back the lender a portion of your mortgage that's more than your regular payment without any penalties or without any issues.
Mhm.
Like I said, the general tends to be between 5 and 25, with the most common ones between 15 and 20. So 15% on $3,500 would mean that you can actually put down another $525 a month without any issues. The nice
Mhm.
part is that prepayment portion that you've just made goes directly to principal, and it can save a significant amount of interest over time when you do that. The other side is so on the total mortgage amount. So if we said you had $800,000 you started with, and you can pay 15% of that every year, that means that you can put down up to $120,000 on that mortgage and really draw the balance down as quick as you're able to. Now, I mean, not everybody has the ability to do that, but I would certainly say take advantage of prepayments when you have them.
Yeah, excellent point, and something that every should consider doing that at least on the principal home.
Oh my
We
gosh.
did in fact talk a lot about this topic in one of our previous episodes. I'll put the link in the description when I post this.
Mm-hmm. Mm-hmm. And just to reiterate again, because I had this conversation the other day with somebody, it doesn't have to be huge amounts. And some lenders may have a minimum amount per month that you must, like if you want to make use of the prepayment on your payments, it's got to be like a minimum of $100.
Yeah.
That's fine. Make the $100 because that probably will save you $110 in interest over the length of the term that you have, believe it or not.
Usually more, maybe it's around 2.5 times, depending on the amount.
I'm being conservative because I don't want people to come back and go, you said 3 times, Neil, look, you owe me the $180 difference. No, I'm just saying, you'd be surprised at how quickly putting down a little extra on your mortgage today can save you in the long run, and the benefits far outweigh the discipline to do it.
Oh, yes, for sure.
Yeah.
Now let's talk about the negative side of it, right? So what if you have to make more prepayments than what your lender allows? That is where the penalty comes in.
Yeah. I got an inheritance. What do I do with it? Inheritance. What do I do with it? Pay off my mortgage.
Now, all lenders allow some degree of prepayment, as Jerome mentioned, 5% to 25%. That could be in terms of lump sum payment of whatever your original mortgage amount was, or your existing mortgage payment. If you are to exceed that limit, then the lender is going to charge a penalty on the amount that you exceeded by, right? And if you have to pay down the entirely, then for sure it will be charged on the entire balance that you're paying. Yeah. Now, depending on the lender, you may have the leeway of first using your prepayment options, or maybe they will not consider that also. So these things vary depending on what your lender's regulations or rules are.
Yeah. Should you talk to a mortgage person about this before you do anything?
Absolutely.
Why? What can we do for them?
We can save you on significant amount of penalty if you're going or planning to go through something like that.
Yeah. Could we set out a strategy in order to pay down a mortgage using prepayment privileges much sooner than if you just paid it off in one shot and incurred all those extra fees?
Well, it makes a difference, as I said, right? Some lenders may consider it, or maybe they will consider it if you do it in a certain way.
Yeah.
Right. So there are scenarios where you could be bringing down the penalty. And so I would say talk to somebody who is knowledgeable, and then they can game the system for you.
Yeah. Yeah. We can definitely help put a plan together so that way you know those benefits and segmentally what best way to move forward, so that way you're not incurring any additional costs. Because who wants to pay the banks? It's like paying CRA. Who wants to do that?
Yeah, they make the billions anyway. So
Exactly. Enough that they can pay some big fines with. Portability. Does that mean I have a porta potty in my house? No. It means, can I move my house? No. You can't move well, you probably could move your house, but I think portability from a mortgage perspective is, I bought a new house. Mm-hmm. I like the interest rate, my friendly little interest rate over here on this house. Can I have the same thing on the new house? Chances are the answer is yes. There are very few times that you're not able to port a mortgage from one property to the next. Most lenders don't allow a variable interest rate to be ported from one property to the next because it's only 3 months interest to pay it off. So just pay it off and then we'll start up a new one. Mm-hmm. But there are a couple of lenders that do allow you to port it from one property to the next. But it's a feature that allows a borrower to take a lower interest rate that they have on one property and carry that over to the next property. So that way they're still benefiting from that lower interest rate. Ultimately, that's what the portability feature is. Are there other things to consider in this? 100%. Talk to a mortgage person before looking at that, because we can really nail down what the overall costs are going to be. If you had a 2% interest rate today and you've got a year left and you want to buy another property in 3 months, is it going to be worth it for you to try to move that 2% interest rate over? Yes, but you might not end up with a 2% interest rate on the next property if your mortgage amount is different. So definitely have a conversation with us to see what that would look like.
It could also help in scenarios if the penalty to break an existing mortgage is way too high. And if there's an option to move that mortgage and not break it,
yes,
maybe it can be helpful in those situations as well.
Yeah. Even if the interest rate is higher, I think, and that's specifically what you're talking about, where, the interest rate's a little bit higher and the penalty to break obviously is going to be higher as well. You might be in a better position to move that higher interest rate mortgage from one property to the next, wait for its term to end before moving on to a different lender and a different rate.
But as always, it's good to know before you take any mortgage to know what your options are with respect to portability if and when a scenario arises.
Yeah.
Again, it also depends on what kind of property you want the mortgage moved to. It is all subject to lender's approval.
Yes.
Even if the mortgage itself is portable.
Yes. Yeah.
Okay. Closely aligned feature is assumability.
Yes. Yeah. I have never ever in my 2009, I'm like 15 years into this, never seen anybody even make use of that or even question it seriously.
I had one case this year.
Really?
Yes.
Did it work?
It worked. It worked to the benefit of the buyer.
Oh, wow.
So the buyer that I was working with wasn't qualified for a lot of mortgage.
Yeah.
And so they were constrained in terms of what properties that they could look at.
Yep.
So they came across a listing which was like there for a long time, and so they went inquired with the seller, and the seller for some reason wanted to for the buyer to take over the mortgage.
Okay.
And it turned out to be to the benefit of this lady because she got a lower rate in a high rate environment, and she got a property at below market. So I don't know what the situation with the seller was, but then that's a unique situation which played out early this year with me.
Yeah. Was it like a 10-year term or a 7-year term?
It wasn't a long term, but somehow I think the seller was maybe not well informed. And that well, I didn't get the business, but still it worked to the benefit of the buyer, the client that I was working with.
Yeah. Wow, that's amazing. I honestly, I know that the option is there on most mortgage commitments that we issue or that we are passing on to our clients, but I have never really seen one happen.
Sure.
Pardon?
It is rare for sure.
Yeah. Yeah. No, I'm excited the fact that you got to even see one. I'm jealous.
Well, I can talk about it now, but it didn't feel good when it happened, at least for me.
Yeah. So if you're assuming somebody's mortgage, you're probably not going to end up talking to us. I think ultimately is what we're hearing here. Okay, so you talked about so portability, which is moving the mortgage that you have from one property to the next. Assuming one is you don't have one and you assume the mortgage on the property that you're buying. Interesting way of talking about it. But what's the next thing? Mortgage stressing testing. Does that mean like
mortgage stress test? And again, I don't know for how long this might continue to linger. It probably is on its way out. We don't know.
Yeah.
But it is a regulation which is in place since 2018, I believe.
Yep.
Wherein the regulator brought in as a qualification measure that somebody who is getting a mortgage today or a fresh new mortgage has to qualify at a rate which is 2% higher than their contract rate, or at least 5.25% as it stands today.
Yes. Yes. So
Again, this might be
yeah.
going out. We don't know yet.
For the longest time, it almost didn't even matter, right?
Mhm.
Because the rates were so low that you could take the rate plus 2 and it didn't equal that 5.25. What does that 5.25 represent, Neil?
It's supposed to be the average posted rate by all the big banks.
Yes.
5-year posted rates by the big banks.
Yeah, supposed to be.
Supposed to be.
And do you remember do you know the last time that number changed?
Sometime during COVID.
Yeah, it was early.
Early part of COVID. Yeah, the pandemic.
I think around 2021 it went up from something like 5.14 to 5.25, and it's been there ever since.
Yeah, they just forgot about it.
Yeah, exactly. They're like, is it doing what we want? It doesn't even matter. It's rate plus 2, whichever is higher, blah, blah, blah.
We're qualifying people at 9%, or we're qualifying close to 9%. So
yeah. I know I did that for some people in the last 12 months. Horrible trying to qualify a mortgage at like 9%.
Yeah.
So if the mortgage stress test doesn't make sense to you, just think that the mortgage is like stressing and testing you. And that's what it's there for. Because that's what it was there for us. All of these gray and little, lighter colored hairs that I have, it's all because of that. Mortgage has stressed and tested me. Here's one that a lot of people hear all the time, but maybe some don't quite understand exactly what it is. A HELOC, or home equity line of credit.
Yeah, it's like a credit card that you have on the house. You can borrow and you can prepay anytime you want without a penalty. So it's a flexible instrument.
Yep.
And the only obligation that you have is, of course, that you have to pay the interest on it monthly.
Yep.
Plus, it's a on-demand loan, which means if the lender wishes, they can ask you to repay the entire amount anytime they want.
Yes. Can anybody get a home equity line of credit on their house?
Well, if you qualify, for sure, but the minimum obligation or the requirement is that you need to have at least 20% equity in the house in order to get a home equity line of credit. And the rules have tightened a bit more in the recent years, wherein your home equity line of credit cannot be more than 65% of the value of the home,
right,
with most federally regulated lenders.
Yes.
With all.
Yeah. Provincially regulated lenders like credit unions aren't necessarily obligated under the same policies. However, what I've seen is most of them are moving towards it anyway.
Mm-hmm.
So I've done in this last 15 years, I've done a couple where somebody had paid off their house and I immediately registered a 80% line of credit through a credit union. So that way they had access to 80% of the value of their house on like a credit card. Swipe it and go buy a car and do whatever. It could be handy if you're into real estate investing, stock market investing, stuff like that, and you have a way to manage those transactions and keep track of all that you're doing. But
or if you have business and you need line of credit.
Exactly. There are a lot of
cheaper than a business line of credit.
Yes. There are a lot of businesses and business owners that during their startup and first couple of years, they rely solely on their home equity line of credit before they get into a business line of credit.
It is risky for sure, but again, it's just cheap.
Yep.
Now you can get a home equity line of credit along with your mortgage, or you could be getting it in a second position as well.
Yep.
Depending on what choices are available with your lender.
Yes. You can get Yeah, and that's a really good point. There are multiple ways that HELOCs are registered. One is through a single charge with one lender, and it's combined with your mortgage. Oftentimes, they call those a readvanceable line of credit. So as your mortgage balance decreases, the line of credit limit increases. See what I'm doing with the hands again? Right? So it helps people when they pay down their mortgage and that limit increases and they have more funds available that they can use for future investments, or like today, the government's actually giving people lower interest rates in order to build additions onto their homes and all that other kind of stuff. So this is something that we would look at to see if that made sense for people in those situations. And then there's the other way where it can be done separately by itself. So it's just a line of credit. If you already have a mortgage, this line of credit can be registered in behind in second position, like Neil said. But still, as Neil had said earlier, the line of credit amount itself usually can't be more than 65% of the overall value of the house. So if you are starting with a low limit because that's the only available credit that you have, then that's all you're going to get. Because if it's registered separately, it's only going to be registered for its amount. So that's something to consider. And we always talk about that kind of stuff with borrowers who are interested in these products. So bridge financing. Are we literally financing bridges?
Well, in some sense, yes, it is a bridge from one mortgage to the other.
Oh, I thought you were going to say like the bridge that goes over that nice little waterway and the water feature that's in your front lawn, one that leads to your pond and all that kind of stuff. Bridge financing.
Yes. So it's usually a very short-term arrangement. Mm-hmm. It typically comes into play when somebody is maybe buying a home before they have sold their existing home, or at least closed on the sale of an existing home.
Yes.
One of the requirements is for bridge financing is that, well, at least with most lenders, is that you should have already secured a firm purchase or a sale agreement on the existing home before you can get a bridge to the new home mortgage.
Yes. So if I can add a little to this story, so you own a home and you decided, I don't like this home anymore, I want to go buy a new one, but I don't have a down payment. The down payment's going to come from the sale of this home. But when I buy the next home, I want to overlap the closing date. So I want to be able to move into the next home before I sell this home, so that way I can, go in and maybe do some painting and cleaning and finishing up the basement or something along those lines. But where's my down payment going to come from? That's effectively what a bridge loan is.
Yeah. Now, not all lenders provide it. So in case you need one, make sure that the lender that you're getting the new mortgage from is able to support it.
Yeah. Do people have to pay for this bridge financing?
Yes, there is a cost associated with it. Their interest rates are generally higher, but since the borrowing period is supposed to be not long or short, the actual cost doesn't work out. Usually, it doesn't work out to be much.
Yeah, dollars a day kind of thing. And it's only for the down payment or the shortfall on the down payment amount. So you might be going in and saying, well, I've got $40,000 for my down payment on that purchase, but $250 is going to come from the sale. So you're borrowing that $250 for 14 days. And the cost of interest per day is one of the ways that the lenders who are offering this bridge financing will charge. And there is often another charge, of course, which is an admin fee. And that can vary anywhere from, I think the lowest I've seen is around $500 and the highest around $1,000. So budget for that when looking at it. And again, of course, if you're talking to us, we'll always help you figure out what that looks like. So that way it's rolled into all the numbers and you understand it.
Yes.
Appraisal. So we have talked about an appraisal before. Yeah, I mean, it's a market evaluation done by a specific licensed individual who assesses the property against the market in order
Mhm.
to come up with an evaluation for the lender,
Yeah.
or sometimes for the buyer. Right? Sometimes buyers can choose. You can do an appraisal on a property if you want, without the lender requesting it.
Yeah,
More often,
you may want maybe need it for tax purposes. There could be a number of reasons why you want to buy it. If you're
yep,
maybe buying out a partner,
yep,
not necessarily a spouse, but maybe you have a partner on a property you're planning to buy out, or they're buying you out.
yes, exactly.
So an appraisal might be needed in that case.
Yep. Um, Title insurance. So, first of all, the title isn't mortgage terminology basics like we're discussing. The title is, what is the title? Tell me what the title is, and then I'll talk a little bit about the insurance.
Well, I'm not very sure about the legal terminology, but at least what it implies is that denotes the ownership of the property.
Hmm.
So essentially, the property remains the same, right? Only the buyers and the sellers or the owners are changing in a transaction.
Yeah.
So if you're buying a property, then the previous owner's name was taken off or removed, and your name is put in. And if you look at the title deed, it will show the history of owners and whatnot. So that's a title and denotes the ownership of your ownership rights to that property.
And so, where is the titles normally kept? Like in your filing cabinet upstairs, or like where would the titles be kept?
So typically it's kept it's the land registry or the property registry with the province, so it is maintained at that level.
Yeah.
Just so that there is public awareness as to who owns what.
Right. And it's registration, right? Like when you buy a car, you go register it at the Ministry of the Transportation. There isn't a Ministry of Home Ownership yet. Google, you're not listening to this. But effectively, that's what happens, right? The title is, oh, Neil Joseph owns this house. We're going to make sure everything is registered in his name, and we're going to tell the municipality that that's who owns this property, exactly like what you said.
Mhm.
So, and that's an important piece of information that a lot of people probably don't get. You don't know, right? Most people, when they when they buy a property, the first thing they think about is that god awful big document that tells everybody you owe hundreds of thousands of dollars called a mortgage. They don't think about the title, like you own something.
Yeah.
And so, what are some of the pitfalls of owning a property, and what kind of things can you use to protect them?
So some of the pitfalls are, well, it's a physical asset, and there might be doubts about where exactly is the boundary of that property.
Yep.
Are there any outstanding claims or fees which are not known at the time of the transaction when you assumed ownership?
Yep.
So, in case there are any faults, and these are typically called as faults, they're issues which arise later on and that you're not aware of at the time of the transaction, then the insurance piece basically protects you against any such claims or damages. And also, there is a different piece to it. So, there is a homeowner's title insurance and there is a lender's title insurance.
Mhm.
And so some lenders would want you to assume that as well, meaning that you pay for that as well, so that the lender's interest in that property while they have extended the mortgage is protected.
So
Mhm.
definitely beneficial, and one of those sneaky little things that just sort of sits there, but can be really, really good.
Yeah, yeah, it's worth the money.
100%. 100%. That one, as an insurance product, I would say is definitely worth the money.
And
Um,
another thing I noticed is that increasingly you don't get land surveys at the time of purchase, meaning the
right.
seller doesn't have a land survey that they can hand over to you. So you're left questioning as to what exactly or
What
how
do
much
you
is
own?
the area of the property, right? So
Yeah.
unless you want to take a survey which can cost thousands, this is a sort of a substitute for that.
Thank you, everybody, for tuning in to this episode of Getting Your Shit Together. Again, I'm Jerome Christensen, and my co-host, or I'm his co-host, one of the other. Pick which one, whatever you like. Thank you, and we'll see you next time.
See you next time, and happy Halloween.
Yes, happy Halloween.